East African community currencies have always been subject to fluctuations against major international currencies such as the US dollar. The East African community consists of countries such as Kenya, Tanzania, Uganda, Rwanda, Burundi, Democratic Republic of Congo, and South Sudan, each with its own currency. The most widely used currencies in the community are the Kenyan shilling, Tanzanian shilling, Ugandan shilling, Rwandan franc, Burundian franc, Congolese franc, and South Sudanese pound. Currencies have their own exchange rates against the US dollar, which can have a significant impact on trade and investment in the region. These are their exchange rates as of April 2024 against US dollar. 1. Kenyan shilling at 132 shillings. 2. Tanzanian shilling at 2,590 shilling. 3. Ugandan shilling at 3,833 shilling. 4. Rwandan franc at 1,288 francs. 5. Burundian franc at 2,869 francs. 6. Congolese franc at 2,790 francs. 7. South Sudanese pound at 130 pounds. The exchange rate of East African currencies against the US dollar is influenced by a variety of factors, including economic indicators, political stability, and market sentiment. Economic indicators are statistics or data points that provide insights into the overall health and performance of an economy. These indicators help economists, policymakers, investors, and businesses assess the current economic conditions, make forecasts, and make informed decisions. Some common economic indicators include GDP, gross domestic product, unemployment rate, inflation rate, consumer spending, industrial production, and housing starts. By tracking and analyzing these indicators, stakeholders can gauge the strength of an economy, identify trends, and anticipate potential changes in the economic landscape. Political stability refers to the absence of political turmoil, unrest, or conflict within a country or region. It is a state of peace, order, and continuity in the political system, where the government is able to maintain control, enforce laws, and provide stability for its citizens and businesses. A politically stable country is characterized by a functioning government, respect for the rule of law, protection of human rights, and a peaceful transfer of power through democratic processes. Political stability is essential for economic growth, investment, and social development, as it creates a conducive environment for businesses to operate, citizens to thrive, and for the country to progress and prosper. Market sentiment refers to the overall attitude or feeling of investors and traders towards a particular financial market, asset, or security. It reflects the collective mood, emotions, and expectations of market participants regarding the future direction of prices. Market sentiment can be influenced by various factors such as economic indicators, geopolitical events, news, company performance, and investor behavior. There are generally two types of market sentiment. 1. Bullish sentiment. When investors are optimistic and expect prices to rise, it is considered a bullish sentiment. This can lead to increased buying activity and upward price movements in the market. 2. Bearish sentiment. When investors are pessimistic and expect prices to fall, it is considered a bearish sentiment. This can lead to increased selling activity and downward price movements in the market. Market sentiment is important because it can impact market volatility, trading volumes, and price trends. Traders often use sentiment analysis to gauge market sentiment and make informed decisions about their investments. In recent years, the exchange rates of East African currencies against the US dollar have been relatively stable, with some fluctuations due to external factors such as changes in global commodity prices or interest rates. However, there have been instances where certain currencies in the region have experienced sharp devaluations, leading to inflation and economic challenges for the affected countries. One of the main reasons for the fluctuations in East African currencies against the US dollar is the region's reliance on imports. Many East African countries import a significant amount of goods and services, which means they need a stable exchange rate to ensure the affordability of these imports. When the local currency depreciates against the US dollar, the cost of imports increases, leading to higher inflation and a decrease in purchasing power for consumers. Here are 4 reasons how reliance on imports affects currency fluctuation. 1. Trade balance. If a country's imports exceed its exports, it creates a trade deficit. To pay for the excess imports, the country needs to buy foreign currency, increasing the demand for foreign currency and putting downward pressure on the domestic currency. 2. Exchange rates. When a country imports a large amount of goods and services, it weakens the domestic currency relative to the currencies of its trading partners. This can make imports more expensive for domestic consumers and exporters more competitive in international markets. 3. Inflation. Reliance on imports can also lead to inflationary pressures. If the domestic currency depreciates due to high import demand, it can lead to higher import prices, which can push up overall inflation rates in the country. 4. Economic stability. A high dependence on imports can make a country vulnerable to external shocks and fluctuations in global markets. Currency depreciation resulting from import reliance can impact economic stability and investor confidence. To mitigate the impact of exchange rate fluctuations, some East African countries have implemented measures such as 1. Foreign exchange reserves. These are assets held by a country's central bank in foreign currencies, such as the US dollar, euro, or yen. 2. Currency pegs. This is a fixed exchange rate system in which a country's currency is tied or pegged to the value of another currency or a basket of currencies. 3. Capital controls. This refers to measures implemented by governments or central banks to regulate the flow of capital in and out of a country's economy. These measures can help stabilize the exchange rate and protect the local currency from excessive volatility. However, they also have limitations and can sometimes be ineffective in the face of external shocks or market speculation. In conclusion, the exchange rates of East African currencies against the US dollar play a crucial role in the region's economy. Fluctuations in these exchange rates can have a significant impact on trade, investment, and inflation, affecting the livelihoods of millions of people in the region. It is important for policymakers in East Africa to monitor and manage these exchange rate fluctuations effectively to ensure economic stability and growth in the region.